Special guest now joins us, someone who needs no introduction whatsoever. Ramesh Damani, member Bombay Stock Exchange. Ramesh, it's a special day for us. Your favorite channel, like I always say, has completed 6 years.
Thank you, Nikunj. Very, very happy anniversary, 6th anniversary to all the three of you and to all your viewers, of course. If you just allow me to say an introduction, I was teaching at Flame in Pune over the weekend, and 1815 or 200 years back, the Battle of Waterloo took place, in which Britain decisively beat France. And on that anniversary, I was teaching the children that one of the great fortunes in the stock market was made because of timely information. Baron Rothschild had an agent who told him that Britain had won the Battle of Waterloo, and he got that news before the market got it and ended up making £1 million sterling, which at that time was a great amount, given ahead in the market. So ET does a great job, and congratulations, and keep doing that.
Promo, guys, promo. This is promo material. Ramesh Damani is endorsing it.
Okay, Ramesh.
You always get these quotes from Ramesh, like always. And one of his favorite quotes has been from economist Benjamin Graham, right? Many shall be restored that now are fallen, and many shall fall that now are in honor.
So, Ramesh, break that quote for us. What does that mean? How should one ponder over this quote of Benjamin Graham?
It's a great synthesis of my experiences in the stock market over the last 25 or 30 years, Nikunj. I've seen through so many bull markets, and you realize a lot of poor quality companies, a lot of hyperbole becomes the favorite of the market at that time. Go back, say to 2000, and you'd see the great rush in stocks like Himachal Global, which were in honor then, and then fall precipitously off a slope. And stocks that have been beaten down, like say Bosch at some point in its life, rise back because they are worth their weight in gold. So as Warren Buffett said, to add another quote, that in the short run the market is a popularity machine. What's most popular wins. But in the long run the market is a voting machine. And this is another way to explain that. So I think not to get carried away by too much optimism or too much distress. In fact, look for great businesses that can compound money for you over long periods of time. That's the secret to becoming wealthy in the stock market.
I'm going to take a leaf of one quote which we've discussed publicly on various forums, which is, good news and great prices, they never come together. 3 months ago, news was good, prices were bad. Right now, news is not all that encouraging, but our price is good.
Nikunj, news is getting better. I think the last set of data that came through the monsoon has started off well. The industrial production number came out well. Oil prices remain flat. I think the two main concerns that the market have now globally, of course, is when will the Fed raise rates, and two, Brexit. When is that going to happen? Now, regarding the first one, if I may suggest to you, that this is the most anticipated rate hike since the dinosaurs roamed the earth. So it's hard to imagine the market getting spooked by a quarter point raise by Janet Yellen. So I think it's well and truly discounted. Whenever they do it, they could do it in September, they could do it in December, or they could even postpone it to next year, as Mark Faber has said. But I believe that the first of the rate discounts is well discounted by the market. I don't think there's too much to fear from it. The second one is the Brexit we talk about. I think it's going to play out over the next few weeks. And again, it seems to me that Greece is an incentive to walk away, because if they give in to the European austerity measures, they in effect are killing their own economy, and Prime Minister Alexis Tsipras will have to face an election in 3 years' time. So, he's not going to go in with a wounded economy. And Germany and France would lose about $180 billion in bond values if they let Greece walk away. So I think this will go on till the last 24 hours, and actually the EU will have to bow down in order to keep Greece in the EU. Either way, I think it is not going to rattle the market too much, because a lot of these scenarios are already played out in the minds of most fund managers. So globally, I think there's not that much to fear at this point. Domestically, of course, will RBI cut rates more? Will better policy measures come up? I think those things will dominate market sentiment for the next few months.
So where does India lie amidst all of this? You've talked about the concern points, but in terms of equities, Ramesh, we've fallen quite a fair bit from the top already. Is there more pain in the system if things were to go awry? I mean, we're already sub 8,000. How much more to go from here? Where is the bottom, or is it even worth predicting a bottom right now?
You know, see, you can break this question down into two parts, Ayesha. You can say that, do we believe that the bull market that started 18 months ago is over? Is the market suggesting that? And B, if it's not suggesting that, what is it suggesting? I'm very clearly in the camp that the market is not suggesting that the bull market that began 18 months ago is over. Yes, it's a very painful period of correction, and stocks may move in the range we've established for another 3 months or another 6 months. But that's typical of, you know, the mid-cycle blues, as I call them. We just have to stick with, stick with the market, because market, you know, the timing of the market is, you know, surely unknown. We have no idea when the market wakes up and starts rebounding. So I would say that. Has the bull market topped out? I mean, the indications are not there. I mean, what would you look for when a bull market tops out? You look for, you know, extreme euphoria on the street. You look for a lot of IPOs coming out there, a lot of margin trade going on, a lot of poor quality companies rising, a lot of wide-eyed optimism. None of them is right now. I mean, the public is in fact underinvested into the cycle at this point. There is absolutely no euphoria on the street. There's reason to believe that corporate earnings will start improving 1, 2, 3 years down the road. So, I mean, where is the question of, you know, bull market topping out at this stage? Can we go through pain? I think there's nothing written that, you know, markets will go up 20% seamlessly year on year, year on year, year on year. I think markets give us non-linear spurts of rises. And I think even if you close flat for the year, it wouldn't dissuade me from the basic motion that a new bull market is underway.
This is Niraj here, of course, and I take it from your answer that you believe we are in the midst of the bull cycle. Typically, the leaders of a bull market don't change so soon. Can this time around things be different, or would you believe the pack which started the bull market would essentially continue to be the one which will be dominant till the very end?
I think it's the latter. I also tend to believe that once the course is set, the leadership is set. Where are the two sectors that we see very clearly providing leadership to the market? One seems in pharmaceutical shares. They all, you know, tend to be very strong, and they tend to come back after every correction. And second is in the so-called quality quadrant that we keep talking about. And if you notice that what has the market punished? Market has punished the poor quality and the high debt-laden companies. It actually hasn't punished, even in this correction, the very high quality companies that are still growing properly. So I would tend to tell you that, you know, the leadership will remain there, but it will be a rising board. A lot of sectors will do well. I'm not saying only pharmaceuticals will do well, or you should only buy this high quality quadrant, which are so expensive that it makes your nose bleed. There are lots of other values out there. Mid-caps have been hammered 30-50% in this correction. So it's not a bad time to go out and, you know, find some great bargains in this market.
You know it much better than at least 3 of us that it is important to invest in quality companies, but pricing perhaps is the most important criteria which will decide the rate of return. We just spoke to the management of Bosch. It's a quality company, but I worry about the P multiple and the market cap a company like Bosch is sitting on. Ditto goes for an Eicher and ditto goes for a Sun Pharma. Do you think quality now is not only priced to perfection, but it is overpriced, at least in Indian stocks?
It seems so temporarily, but, you know, it's a very dear friend of mine once told me that, and it's in colloquial language in Hindi, he said, Ramesh, dhyan rakhna, nepensiro rehta hai, dharavi rehta hai. You know, the wisdom of that was that high quality is high quality, and people will always pay a price for living in Nepean Road and may not pay a price to live in Dharavi. So it's hard to say, you know, is, for example, 60p expensive, cheap, and 65 very expensive. You know, I'm not in a position to tell that on a blanket basis on every stock out there, but my wisdom over years have taught me that you want to remain in the high growth, high quality quadrant as far as possible. So, you know, without being able to discuss stocks, I think that's the best I can do. I'm not going to be shaken out of some great high quality stocks because the market thinks they are overvalued, or because by conventional measures they are overvalued. Stocks can remain overvalued for long periods of time, and then the fundamentals change and they go up another spurt. So, you know, you have to take it case by case, Nikunj. That's the best answer I can give you.
I know, Ramesh, you can't understand stocks, and let's leave Nepean Sea Road and Dharavi aside. Let's identify a BKC 7 years back. What is that one parcel which is going to give you phenomenal returns if you sit it out for the next 5 to 7 years? Any space which is looking interesting right now, which could give you that kind of multiple growth?
I sound like a broken record when I say it, so I'm very reluctant to say it. I think media will do well. I mean, my media friends are the most disappointed in me when I say that. But I can't understand the market caps. I'm sorry, I just can't understand the valuations of these companies. Some of them have done well. I think there will be a shakeout in the media. But the winners will, it'll be a winner-take-all type of economy. So, that's perhaps my dark horse sector to look at. E-commerce is booming, but now it's probably well recognized. So I don't think there's a newness about it. You look at through small cap, mid cap stocks, not necessarily in a sector, but case by case. I think you'll find some stocks, as Benjamin Graham said, that, have fallen and are waiting to be restored.
Let's put a graphic which says some of the big ideas or big picture ideas from Ramesh Damani. He's discussed that one should bet on e-commerce companies, but indirectly, which means you buy paper companies, cardboard companies, logistics. We've discussed this one before with him. Big data, another billion-dollar or trillion-dollar opportunity which is staring at our face, and then he also is bullish on select mid-cap IT stocks. Ramesh, when it comes to IT, one has to be extremely stock specific, but if I look at the earnings trajectory from mid-cap IT, with the exception of one or two, across the board there has been a disappointment. Do you think there is a big reset which has happened in the entire mid-cap IT space, because the world has changed, the world has moved towards digital and SMAC, and Indian IT companies or Indian mid-cap IT companies are struggling there?
I think there's a fear more than actuality that's happening. There's a fear that will happen, and I think the market is knocking these stocks in advance of that. Actually, when I look at the individual companies that I bought in the mid-cap IT space, management is not guiding for anything bad this coming years. In fact, they're all guiding for positive growth, better dividend payouts, good vision for the next couple of years. So I think the market is perhaps ahead of the curve on this. There is a lot of debate on the large street. There's a reset going on, that project sizes are changing, project timelines are changing. But particularly in the mid-cap basket stock, I don't find my companies giving me the same information.
Ramesh, I have two questions rolled into one. One, where is it, or where in the market are you a minority on, if you are in the first place? And two, is there anything that is in its nascent stage right now? I mean, we talk about the kind of money that PE investors are making because they are identifying ideas at the very start and then betting on them big. Is there anything in the listed space in terms of themes which is at a very nascent stage right now?
Well, to answer your first question, that where am I in a minority? I think for 30 years we've been bullish on India and bullish on Indian stocks. And if you look at, I started my career, Niraj, in 1989 when the Sensex was 600-800, something in that region. Today it's 30,000. So it's almost like a 50x move in a period of say 25 years, which translates into a compounding of 17-18%, most of it tax free. And we've almost always, except for brief periods when the market was looking like headed down, been bullish. And the Indian public has always been in a minority. They've always betted on real estate, they've always betted on gold, which are so inefficient, so tax inefficient and non-productive. There have been periods they worked. So we've been in a minority on that we've always been bullish on India Inc. We believe that, stocks return great value to investors and that they build great businesses. Go back to the 91, 92 after liberalization. Because we had the stock market, we created companies like Lever, Reliance, ITC, Infosys. I mean, the amount of wealth creation has been truly stupendous. 17-18% tax free on an index level. So I think that has clearly been, for us, the minority position. The majority has been against us, but I think the markets have indicated us. I think great businesses have climbed in value. If you didn't chase the fraud of the day or the favorites of the day, and you stuck with high quality businesses, and you stuck with good managements, and you stuck with conservative payout ratios, I think those stocks have multiplied 10x, 20x, 50x over the last 25 years or so. So clearly I think the minority position that has been vindicated has to be bullish on the stock market and bullish on India, because that has where the serious money has been made. Coming back to which is a nascent sector which I would feel minority, I mean, I would have felt that about, the derivatives of the e-commerce play a few years back, the logistics play, because they are straight play on e-commerce, for example, media, packaging, data, if you will. So, I'm not really sure I'm finding that in great measure anymore. I still think, as I said before to Ayesha, that, media offers one of the great opportunities in India. Some of the stocks have begun to get recognized. Some of them have moved up very nicely over the last 6 months or so. But I think there's generally a lot of disdain about these stocks. And my experience tells me that, the kind of businesses they are, the powerful nature of the businesses, whether they're going online or whether they are a television broadcasting network or whether they have distribution, are just too powerful businesses to remain at these market caps. I think ultimately the regulatory environment will change, digitization will be widespread, and a great amount of value creation will occur in this sector.
Ramesh, I recall chatting with you a few months back, and at that time I remember you had mentioned about some of the MNC names and as to how those stocks are completely broken down and this is a good opportunity. Is that still a good trade?
I think some have done well, some are doing well. I still have, a long position in the stocks which we talked about that time. Unfortunately, these SEBI regulations make us so wary about talking on air, Ayesha, so you will forgive me for this. But, I think a lot of them will have to wait for the economic cycle to change before they deliver superior returns. They're also linked to the economic cycle. But, to answer your question in brief, yes, my money is still in those stocks and I'm still, quite hopeful about them.
We always talk markets with you, but today I've got a special graphic for our viewers and we've got a list of the websites which you love to read and you like to be on. So why don't you walk us through those names? I'm sure our viewers who track you, they would immensely benefit from this initiative.
Whenever some kid comes to me and asks me that how do I become better in the stock market, I always tell them that the first thing you need to do is to read a lot. If he says I read 2 hours a day, I say do 4 hours a day. If they say 4 hours, I read 6 hours. Because that's what's important for a career in the stock market. Reading is your raw material, and not necessarily reading a balance sheet, reading about stocks, but a broad-based liberal education type of reading. Philosophy, politics, art, society, everything is important. And typically you would have pushed them towards books or the financial press. But increasingly I find a lot of my reading comes to these two websites which you have on your graphic. One is called thebrowser.com, other is longform.org. One of them is a slight pay site. I think browser charges $20 a year. Longform is free. What they do is their editors curate good reading from across the web, across the print journalism, and put it there. And you can spend and read about a variety of issues, from the rise of ISIS to the rise of biotechnology. Everything is curated and put by a very smart set of editors out there. And I think it's an absolute great place to, spend a few hours every day reading. It's practically free, and some of the greatest insights and the sharpest judgments I get from reading those sites. So I would strongly recommend, particularly to the young ones who want to start a career in the stock market, that those two are great places to begin reading.
Okay, great, Ramesh. I know if I start a question on books, we'll probably have a long list out there. I remember long-term capital management as the first ones, but yeah, I'm sure that will save for another day. But Ramesh Damani, it's been a pleasure having you today. Thank you so much for taking the time out and joining us.
Thank you guys. Have a great one.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.